The Intelligent Investor. Introduction. The Intelligent Investor is a book written by Benjamin Graham, published in 1949. Graham is considered the father of value investing and was also the mentor of Warren Buffett, who is considered one of the most successful investors of all time. The book provides guidance on how to invest in stocks and bonds in a way that minimizes the risk of losses and maximizes the potential for long-term gains. Graham's approach to investing is based on the concept of value investing, which involves buying stocks that are undervalued by the market and holding them for the long term. Graham also emphasizes the importance of conducting thorough research and analysis of companies before investing, as well as diversifying one's portfolio to reduce risk. The book has become a classic in the field of investing and is still widely read and studied by investors today. Part 1: Investment versus Speculation. Chapter 1: Investment versus Speculation, Results to be Expected by the Intelligent Investor. Chapter that lays out the key principles of value investing and distinguishes it from speculation. Graham argues that an intelligent investor should focus on investment rather than speculation, and provides a framework for how to approach investing in a rational and disciplined way. The chapter begins by defining investment and speculation. An investment, according to Graham, is an operation that promises safety of principal and a satisfactory return. This is in contrast to speculation, which offers the possibility of large profits but also carries the risk of significant losses. Graham argues that while some may be successful at speculation, it is not a reliable way to achieve long-term financial security. Graham's focus on investing rather than speculation is based on the principle of a margin of safety. This is the idea that an investor should only buy securities when their market price is significantly below their intrinsic value. By doing so, the investor provides a buffer against potential losses and reduces the risk of permanent capital impairment. The concept of a margin of safety is a key tenet of value investing and is based on the idea that the market can be irrational in the short term, but will eventually correct itself over the long term. By buying securities at a discount to their intrinsic value, the investor can benefit from this correction and earn a satisfactory return. In addition to the concept of a margin of safety, Graham emphasizes the importance of discipline and a long-term perspective in investing. He warns against the dangers of following market trends or getting caught up in emotional reactions to market fluctuations. Instead, he advocates for a rational and disciplined approach to investing that focuses on long-term results rather than short-term gains. Graham also notes that successful investing requires a certain degree of expertise and knowledge. He argues that investors should take the time to educate themselves about financial statements, company operations, and economic trends in order to make informed investment decisions. Finally, Graham emphasizes the need for diversification in investing. He argues that investors should not put all their eggs in one basket and should instead spread their investments across a variety of securities and asset classes. This reduces the risk of significant losses due to the failure of a single investment. Chapter 2: The Investor and Inflation. Chapter 2 focuses on the impact of inflation on investments and the strategies that investors can use to protect themselves against the erosion of their purchasing power. Graham begins the chapter by defining inflation as the gradual increase in the general level of prices of goods and services over time. He notes that while inflation may seem like a minor concern in the short term, over the long term it can have a significant impact on an investor's purchasing power and can erode the value of their investments. One of the key strategies that Graham recommends for protecting against inflation is investing in equities or stocks. He argues that over the long term, stocks have historically outperformed other asset classes and have been able to provide returns that keep pace with or exceed inflation. He also notes that stocks can provide a hedge against inflation because companies can raise their prices to offset rising costs and maintain their profit margins. Graham acknowledges that investing in stocks carries some risks, but he argues that these risks can be managed through a diversified portfolio and a focus on investing in well-established companies with a proven track record of success. In addition to stocks, Graham also recommends investing in bonds with a maturity that matches the expected duration of inflation. By doing so, investors can ensure that they are earning a return that keeps pace with inflation and that their purchasing power is not eroded over time. Graham also emphasizes the importance of avoiding investments with fixed returns, such as savings accounts or bonds with fixed interest rates. These investments are vulnerable to the erosion of purchasing power caused by inflation and can result in a significant loss of wealth over time. Finally, Graham notes that inflation can also have an impact on the way that investors approach the valuation of securities. He argues that in times of high inflation, traditional methods of valuation may be less reliable and that investors should focus on the underlying fundamentals of a company rather than relying solely on valuation metrics. Chapter 3, A Century of Stock Market History, The Level of Stock Prices in Early 1972. This chapter provides a historical perspective on the stock market and the factors that have influenced stock prices over the past century. The chapter also discusses the level of stock prices in early 1972 and provides insight into the potential risks and opportunities for investors at that time. Graham begins the chapter by noting that the stock market has experienced significant fluctuations over the past century, with periods of both boom and bust. He argues that these fluctuations are driven by a variety of factors, including economic conditions, political events, and changes in investor sentiment. Graham also notes that while the stock market has experienced significant growth over the past century, this growth has not been linear and has been punctuated by periods of volatility and decline. He emphasizes the importance of a long-term perspective in investing and warns against trying to time the market or make investment decisions based solely on short-term fluctuations. In discussing the level of stock prices in early 1972, Graham notes that the market was experiencing a period of high valuations and that many stocks were trading at historically high price-to-earnings ratios. He cautions investors against buying into the market at these high valuations and instead recommends a focus on value investing and finding stocks that are trading at a discount to their intrinsic value. Graham also notes that the market was experiencing a period of significant economic uncertainty, with concerns about inflation and political instability. He argues that these factors could lead to a significant market correction and emphasizes the importance of a margin of safety in investing. Part 2, The Investor and Market Fluctuations. Chapter 4, General Portfolio Policy, the Defensive Investor. This chapter focuses on the portfolio policy for the defensive investor. Graham defines the defensive investor as an investor who is primarily concerned with the preservation of capital and who is willing to accept lower returns in exchange for a lower level of risk. Graham emphasizes the importance of asset allocation for the defensive investor and recommends a portfolio consisting of a mix of stocks and bonds. He argues that stocks should make up between 25% and 75% of the portfolio, depending on the investor's individual circumstances and risk tolerance. The remainder of the portfolio should be invested in high-quality bonds, with a focus on short to intermediate-term maturities. Graham also emphasizes the importance of diversification for the defensive investor, recommending a portfolio consisting of at least 10 different stocks and at least 5 different bonds. He notes that diversification can help to reduce risk and protect against individual security or sector-specific risks. In addition to asset allocation and diversification, Graham also recommends a focus on low-cost investing for the defensive investor. He argues that high fees and expenses can erode investment returns over time and that investors should prioritize low-cost index funds or exchange-traded funds, ETFs, as a way to gain broad exposure to the stock and bond markets. Graham also emphasizes the importance of a long-term perspective for the defensive investor. He notes that short-term fluctuations in the market can be unpredictable and can lead to emotional decision-making by investors. By taking a long-term perspective and maintaining a focus on asset allocation, diversification, and low-cost investing, the defensive investor can stay on track toward their investment goals. Chapter 5, The Defensive Investor and Common Stocks. This chapter continues the discussion on the defensive investor, specifically focusing on common stocks as an investment option. Graham emphasizes that while common stocks offer the potential for higher returns than bonds, they also come with a higher level of risk. Graham notes that the defensive investor should approach common stock investing with a focus on value investing and a margin of safety. He recommends that investors look for stocks that are trading at a discount to their intrinsic value and that have a strong track record of earnings and dividends. In addition, Graham recommends that the defensive investor focus on large, well-established companies with a history of stable earnings and dividends. He argues that these companies are more likely to weather economic downturns and that they offer a lower level of risk than smaller or less established companies. Graham also emphasizes the importance of diversification for the defensive investor. He recommends that investors hold a portfolio of at least 10 different common stocks, spread across different sectors and industries. By diversifying across different stocks, the defensive investor can reduce the risk of significant losses from individual stocks or sectors. Finally, Graham notes that the defensive investor should focus on a long-term investment horizon and should not be swayed by short-term market fluctuations. He argues that common stocks can be volatile in the short term, but that over the long term, they offer the potential for significant returns. Chapter 6. The Defensive Investor and Bonds. This chapter discusses the role of bonds in the portfolio of the defensive investor. Graham notes that while bonds may offer a lower level of return than stocks, they also come with a lower level of risk and can play an important role in diversifying a portfolio. Graham recommends that the defensive investor focus on high-quality bonds, such as U.S. government bonds or highly rated corporate bonds. He notes that these bonds offer a lower level of risk than lower-rated or high-yield bonds, but they also offer a lower level of return. In addition, Graham emphasizes the importance of matching the maturity of the bond to the investor's investment horizon. He recommends that the defensive investor focus on bonds with maturities of 5 to 10 years, as these bonds offer a reasonable level of return and are less sensitive to interest rate fluctuations than longer-term bonds. Graham also notes that the defensive investor should focus on a laddered bond portfolio, which involves investing in bonds with staggered maturities. This approach helps to reduce the risk of interest rate fluctuations and provides a consistent stream of income. Finally, Graham emphasizes the importance of diversification for the defensive investor's bond portfolio. He recommends that investors hold a portfolio of at least 5 different bonds, spread across different issuers and industries. By diversifying across different bonds, the defensive investor can reduce the risk of significant losses from individual bonds or issuers. Chapter 7. Portfolio Selection for the Enterprising Investor, Negative Approach. This chapter shifts its focus to the enterprising investor, who is willing to devote time and effort to research and analysis in order to achieve higher returns than the defensive investor. However, Graham notes that the enterprising investor must also be willing to accept a higher level of risk. Graham recommends that the enterprising investor use a negative approach to portfolio selection, which involves screening out stocks that do not meet certain criteria. This approach can help to reduce the number of potential investments to a more manageable level and can increase the likelihood of finding undervalued stocks. The negative approach involves screening out stocks based on quantitative factors, such as a high price-to-earnings ratio or a low dividend yield. Graham also recommends screening out stocks based on qualitative factors, such as a poor track record of earnings or management, or a weak competitive position in the industry. By screening out stocks based on these criteria, the enterprising investor can reduce the universe of potential investments to a more manageable level. This approach can also help to identify stocks that are undervalued and have the potential for higher returns. Graham notes that the enterprising investor should also focus on diversification, but should be willing to hold a smaller number of stocks than the defensive investor. He recommends holding a portfolio of at least 10 different stocks, spread across different industries and sectors. Chapter 8. The Investor and Market Fluctuations. Discusses the topic of market fluctuations and their impact on the investor. Graham notes that market fluctuations are a normal and expected part of investing in the stock market, and that investors should be prepared to deal with them. Graham emphasizes that the most important factor in dealing with market fluctuations is maintaining a long-term perspective. He notes that short-term market fluctuations are often unpredictable and can be driven by a variety of factors, including economic conditions, political events, and investor sentiment. However, over the long term, the stock market tends to reflect the underlying performance of the economy and the companies that make up the market. Graham also emphasizes the importance of having a sound investment strategy that is based on fundamental analysis and a rational approach to risk. He notes that investors should focus on buying stocks that are undervalued based on their earnings and assets, and that they should be prepared to hold on to these stocks for the long term. Graham acknowledges that market fluctuations can be difficult to deal with emotionally, and that investors may be tempted to make rash decisions based on short-term market movements. However, he notes that this type of behavior can lead to poor investment decisions and can ultimately harm the investor's long-term returns. In order to avoid making emotional decisions based on market fluctuations, Graham recommends that investors develop a plan for their investments and stick to it. This plan should be based on the investor's financial goals, risk tolerance, and investment horizon, and should be reviewed and adjusted periodically as needed. Part 3. Investing in Investment Funds. Chapter 9. Investment Funds. This chapter focuses on investment funds, which are a type of collective investment vehicle that allows investors to pool their money together and invest in a diversified portfolio of securities. Graham notes that there are two main types of investment funds: mutual funds and closed-end funds. Mutual funds are open-ended, meaning that investors can buy and sell shares at any time, and the fund manager invests the money raised from the sale of shares in a diversified portfolio of securities. Closed-end funds, on the other hand, issue a fixed number of shares, which are traded on an exchange, and the fund invests in a diversified portfolio of securities. Graham acknowledges that investment funds can be a convenient way for individual investors to gain exposure to a diversified portfolio of securities without having to conduct their own research and analysis. However, he also notes that there are some potential drawbacks to investing in funds, including higher fees and the potential for underperformance compared to the broader market. Graham recommends that investors be cautious when selecting investment funds, and that they focus on funds with a proven track record of consistent performance and low fees. He also notes that investors should be aware of the fund's investment strategy and the types of securities that it invests in, as this can impact the risk and return characteristics of the fund. Finally, Graham notes that investors should be aware of the potential tax implications of investing in funds, as distributions from the fund can be subject to capital gains taxes. He recommends that investors consider investing in tax-efficient funds or holding funds in tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401k plans. Chapter 10. Investment Company Arithmetic, the Fundamentals. Chapter 10 of The Intelligent Investor is focused on investment company arithmetic, which refers to the analysis of the financial statements and performance metrics of investment companies such as mutual funds and closed-end funds. Graham notes that understanding investment company arithmetic is important for investors who are considering investing in funds, as it can help them evaluate the performance and expenses of the fund, and determine whether it is a good investment. The chapter covers several key financial metrics that investors should consider when evaluating investment companies, including the net asset value, NAV, of the fund, the expense ratio, and the sales load. The NAV is the total value of the fund's assets divided by the number of shares outstanding, and it provides a measure of the fund's overall performance. The expense ratio is the percentage of the fund's assets that are used to cover the fund's operating expenses, and it can have a significant impact on the investor's returns. The sales load is a fee that is charged to investors when they buy or sell shares in the fund, and it can also impact the investor's returns. Graham also discusses the concept of dollar-cost averaging, which refers to the practice of investing a fixed amount of money in a fund at regular intervals over a period of time. Dollar-cost averaging can help investors to smooth out the impact of market fluctuations on their investments, and can result in a lower average cost per share over the long term. Finally, Graham notes that while understanding investment company arithmetic is important, investors should not rely solely on these metrics when making investment decisions. He recommends that investors conduct their own research and analysis, and consider factors such as the fund's investment strategy, the experience of the fund manager, and the risks and opportunities of the market. Part 4. The Investor and His Advisors. Chapter 11. Security Analysis for the Lay Investor. This chapter of The Intelligent Investor is focused on security analysis for the lay investor, or individual investor who is not a professional analyst or investment manager. The chapter covers the basic principles of security analysis and provides guidance on how individual investors can conduct their own analysis of securities. Graham notes that the goal of security analysis is to identify securities that are trading at prices below their intrinsic value, which is the true underlying value of the security based on its fundamentals. The key to successful security analysis is to conduct a thorough and disciplined analysis of the company's financial statements and other relevant information, and to avoid emotional or irrational investment decisions. The chapter covers several key principles of security analysis, including the importance of understanding the business and financial characteristics of the company, the need to consider both quantitative and qualitative factors in the analysis, and the importance of taking a long-term perspective. Graham also provides guidance on how to conduct a basic analysis of a company's financial statements, including the income statement, balance sheet, and cash flow statement. He notes that investors should pay particular attention to key financial ratios such as the price-to-earnings (PE) ratio, the price-to-book (PB) ratio, and the debt-to-equity ratio, which can provide valuable insights into the company's financial health and potential for future growth. Finally, Graham emphasizes the importance of diversification in security analysis, noting that investors should not rely too heavily on a single security or industry, but instead should maintain a diversified portfolio of securities. Chapter 12, The Dividend Factor in Common Stock Investing. Graham argues that dividends are an important factor to consider when investing in common stocks, as they provide a tangible return on investment and can serve as a reliable indicator of a company's financial health and stability. Graham notes that dividends are a sign of a company's commitment to its shareholders, and that companies that consistently pay dividends tend to be more stable and financially sound than those that do not. He also argues that dividends provide a cushion against market downturns, as investors can continue to receive a return on their investment even if the market is declining. The chapter covers several key principles of dividend investing, including the importance of focusing on companies that have a history of paying dividends, the need to consider both the dividend yield and the dividend growth rate in evaluating a stock's potential return, and the importance of considering the tax implications of dividends. Graham also discusses the concept of dividend reinvestment plans, DRIPs, which allow investors to automatically reinvest their dividends back into the stock, potentially increasing their returns over the long term. Finally, Graham notes that while dividends are an important factor to consider in common stock investing, they should not be the sole focus of the investor's analysis. Investors should also consider the company's overall financial health, market position, and growth potential, as well as broader economic and market trends. Chapter 13, The Defensive Investor and Income Bonds. Graham notes that income bonds are a type of fixed income security that can provide a reliable source of income for investors, particularly those who are looking to generate a regular stream of cash flow in retirement or other periods of low risk tolerance. Graham notes that income bonds differ from growth stocks in that they are typically less volatile and offer a more predictable return on investment. He also notes that income bonds can be particularly attractive to investors who are risk-averse and looking to protect their principal investment. The chapter covers several key principles of income bond investing, including the importance of selecting high-quality bonds with a low risk of default, the need to consider both the bond's yield and its credit rating in evaluating its potential return, and the importance of diversifying across a range of different bonds to mitigate risk. Graham also discusses the concept of bond laddering, which involves investing in a range of bonds with varying maturity dates to create a steady stream of income over time. Finally, Graham notes that while income bonds can provide a reliable source of income for investors, they may not be appropriate for all investors and should be considered as part of a broader portfolio strategy. Investors should also consider the potential impact of inflation on the value of their fixed income investments and explore other investment options, such as dividend-paying stocks or real estate investment trusts, REITs, to achieve a more balanced portfolio. Chapter 14, Stock Selection for the Enterprising Investor. Graham notes that while the defensive investor should focus on low-risk, reliable investments such as bonds and blue-chip stocks, the enterprising investor can take a more active approach to investing and seek out undervalued or overlooked stocks that may have the potential for high returns. The chapter covers several key principles of stock selection for the enterprising investor, including the importance of conducting a thorough analysis of the company's financial statements, market position, and growth potential, as well as the need to consider broader economic and market trends. Graham also discusses several different methods for evaluating stocks, including the price-to-earnings ratio, PE ratio, the price-to-book ratio, PB ratio, and the dividend yield. He notes that while these metrics can be helpful in evaluating a stock's potential return, investors should also consider qualitative factors such as the company's management team, competitive advantages, and industry trends. The chapter also covers several common mistakes that investors may make when selecting stocks, including overvaluing the potential of new or emerging technologies, failing to adequately consider the impact of inflation on a company's profitability, and succumbing to emotional biases such as greed or fear. Finally, Graham notes that stock selection for the enterprising investor requires a significant amount of research, analysis, and discipline. Investors should be prepared to devote substantial time and resources to their investment strategy and should be willing to adjust their approach as market conditions and economic trends change over time. Chapter 15. Convertible Issues and Warrants. Graham notes that while these securities are not commonly used by the average investor, they can offer unique opportunities for those who are willing to do their research and understand the risks involved. Convertible issues are bonds or preferred stocks that can be converted into common stock at a predetermined price. This allows investors to benefit from any potential upside in the stock price while still receiving the regular income payments associated with the bond or preferred stock. However, convertible issues also come with their own set of risks, including the possibility of the company defaulting on its debt or the stock price failing to rise enough to make the conversion worthwhile. Warrants, on the other hand, are options that give the holder the right to buy a certain number of shares of common stock at a predetermined price for a set period of time. Warrants can offer investors the potential for high returns, but they also come with a higher level of risk and require careful analysis of the underlying company's financials and growth potential. Graham notes that investors should approach convertible issues and warrants with caution, as they are often more complex than traditional stocks and bonds. Investors should carefully evaluate the terms of each security, including the conversion price, conversion ratio, and expiration date, as well as the financial health and growth potential of the underlying company. In addition, Graham emphasizes the importance of diversification when investing in convertible issues and warrants. Because these securities often carry higher levels of risk, investors should maintain a diversified portfolio that includes a range of asset classes and investment opportunities. Part 5. The Intelligent Investor and His Investments. Chapter 16. The Intelligent Investor and Market Psychology. Graham argues that while stock market movements can be influenced by economic and financial factors, they are ultimately driven by human emotions and psychological biases. Graham identifies several common psychological biases that can lead investors to make irrational decisions. These include 1. Herd mentality, the tendency to follow the crowd and invest in popular stocks, even if they are overvalued or not a good fit for one's portfolio. 2. Fear and greed, the tendency to be swayed by short-term market fluctuations and make emotional decisions based on fear or the desire for quick profits. 3. Overconfidence, the tendency to overestimate one's ability to predict market movements and pick winning stocks. Graham notes that these psychological biases can be particularly dangerous for the average investor, who may lack the time and resources to conduct thorough financial analysis and research. As a result, Graham advises investors to adopt a disciplined and rational approach to investing, based on sound financial principles and a long-term investment horizon. One way to do this, according to Graham, is to establish a well-diversified portfolio of stocks and bonds that are appropriate for one's individual risk tolerance and investment goals. Investors should also avoid the temptation to constantly buy and sell stocks in response to short-term market fluctuations, and instead focus on the long-term growth potential of their investments. Chapter 17. The Investor and His Own Psychology. Graham argues that an investor's temperament and behavior can play a crucial role in their ability to make successful investment decisions. Graham notes that successful investing requires a certain temperament, which he calls the proper psychological approach. This approach involves a number of key characteristics, including discipline, patience, and a willingness to stick to a well-thought-out investment plan even in the face of market fluctuations. In order to cultivate the proper psychological approach, Graham advises investors to be aware of their own strengths and weaknesses as investors. He notes that successful investors are often those who are able to recognize their own limitations and work to mitigate them through careful planning and self-discipline. Graham also also emphasizes the importance of maintaining a rational and objective approach to investing and avoiding emotional or impulsive decision-making. This requires a willingness to accept losses and learn from mistakes, as well as the ability to maintain a long-term perspective on one's investment goals. Chapter 18. Investing in investment counselors or advisors. Graham argues that while many investors choose to manage their own portfolios, others may benefit from the advice and guidance of professional investment counselors or advisors. Graham notes that there are a variety of different types of investment counselors and advisors, each with their own strengths and weaknesses. Some may specialize in particular investment strategies or asset classes, while others may offer more general investment advice. In order to choose the right investment counselor or advisor, Graham advises investors to carefully evaluate their own investment goals and needs, as well as the track record and reputation of any potential advisors. He notes that it is important to look for advisors who have a long-term perspective and who are able to provide objective and independent advice, rather than simply pushing particular investments or strategies. Graham also emphasizes the importance of transparency and communication in the investor-advisor relationship. He notes that investors should always be clear about their investment goals and expectations, and should be sure to ask plenty of questions and seek clarification when needed. Part 6. Supplementary Chapters. Chapter 19. Margin of Safety as the Central Concept of Investment. The chapter begins with a discussion of the importance of risk management in investment, and notes that successful investing requires a focus on preserving capital as well as generating returns. Graham defines margin of safety as the difference between the intrinsic value of an investment and its market price. He notes that a margin of safety provides a cushion against the risks of market fluctuations and unexpected events, and allows investors to protect their capital and minimize losses. Graham argues that the concept of margin of safety should be applied to all investment decisions, whether one is investing in stocks, bonds, or other assets. He notes that the most successful investors are those who are able to identify undervalued investments with a large margin of safety, and who are willing to be patient and disciplined in their investment approach. In order to apply the concept of margin of safety to their investment decisions, Graham advises investors to focus on fundamental analysis and to carefully evaluate the intrinsic value of the investments they are considering. He notes that this requires a deep understanding of the underlying financial and economic factors that drive investment returns, as well as a willingness to be conservative in one's assumptions and to err on the side of caution. Chapter 20. Mr. Market. Mr. Market, which Graham uses to illustrate the psychological forces that drive market fluctuations and the behavior of investors. Graham imagines Mr. Market as a person who offers to buy or sell shares of a company at a particular price every day, regardless of the underlying fundamentals of the business. Sometimes Mr. Market is optimistic and offers high prices, while at other times he is pessimistic and offers low prices. Graham notes that the key to successful investing is to recognize Mr. Market for what he is, a manic-depressive individual who is prone to overreacting to short-term events, and to use this knowledge to one's advantage. Graham argues that investors should take advantage of Mr. Market's fluctuations by buying undervalued stocks when he is feeling pessimistic and selling overvalued stocks when he is feeling optimistic. He notes that this requires discipline and patience, as well as a willingness to ignore the short-term fluctuations and focus on the long-term fundamentals of the businesses in which one is investing. Graham also notes that the metaphor of Mr. Market can be used to illustrate the importance of psychological factors in investing. He notes that investors are often driven by emotions such as fear and greed, and that these emotions can lead to irrational decisions and poor investment performance. By recognizing the psychological forces at play and maintaining a disciplined, rational approach to investing, investors can avoid the pitfalls of emotional decision-making and maximize their chances of success. Conclusion. In conclusion, The Intelligent Investor by Benjamin Graham is a classic book on investing that provides a comprehensive and timeless approach to successful investing. Graham emphasizes the importance of value investing, which involves buying assets at a price significantly below their intrinsic value, and the need for a margin of safety to protect against losses. The book offers practical advice for both defensive and enterprising investors, including portfolio strategies for different types of investors and insights into market psychology and investor behavior. It also provides guidance on how to analyze securities and select stocks based on fundamental principles.